The end game in trading. Hi, this is Charlie giving you Friday/Saturday's video, and the one that I want to go through some examples with you today because when I'm talking about the end game in trading, we often talk about you've got to stay in the game. You've got to be able to stay in the game, and the way to stay in the game is to maintain liquidity and to not blow up, of course. And the way we do that is to use normal sort of risk parameters, so only risking a certain amount, typically 1% or less. I know some of our traders do go a bit higher, toward, if you've got a small account they might go to 2%, but that's as high really as I hear, really, if people wanting to stay strict. So but then you hear about these people that are out there, and these are people who have been around the block for a long time. And I've literally heard this week about a trader who had got long S&P and was nightingaleing in. So nightingaleing is a technique. It is a technique in trading and in other poker, or not, maybe not poker, but blackjack and other gambling events, whereby you get in and then you add some more if it comes down against you. So that if I bring the pen up, so if you've got in here, the market's come down a little bit, then you've dollar cost averaged at this level, and then if it bounces back up before you've even pretty much got back to your break-even point and your original entry, then you're in profit, of course. So it's dollar cost averaging, which works a lot of the time. It will work a lot of the time, but bear with me on this because, like I said, you've got to stay in the game for the long run, because you can merrily be dollar cost averaging through all of this, and making some good money, making some decent money. But then you go and get an event such as we're having now, which blows out the normal standard deviations. And it's a bit like, I was talking to our traders yesterday about in like 1997, I think, when we had the long-term capital management collapsed, because they had all these models, but the models didn't take into consideration what went on in Russia and with their currency crisis that happened at that time, and it blew their models, all their formulas out of the water, and they collapsed. They had a massive collapse back then, and so you can be trading merrily along using Nightingale, adding in when price dip comes down against you. I've got the S&P here, and then this happens, and so I've heard about this trader this week who's, I think, practically blown up, because he's added in here, he's added, and in the past that's worked, and then it'll bounce, and then he's okay. But now and again you get these situations where the market doesn't adhere to normal support levels when it's coming down, like in what we've seen at the moment. It doesn't adhere necessarily to those levels. It has little bounces, and we had that bounce off of these levels, fair enough. But if you've already been in from right up here, even this bounce wouldn't have been enough for him. And then, of course, it's rolled over, so he's adding in again and ended up sort of blowing up. So now you can use Nightingale. You can use that technique if you're still using it within a risk parameter framework. If you're using it with zero stop losses, then again, I know I talk about this frequently, but you hear about traders all around the world who trade without stops, and they say to you, I use a mental stop, Charlie. You're like, yeah, but mental stops aren't very good when you're in the thick of things and the market's flying down against you. Are you still going to have that mental capacity to come out? And the answer is no, because someone's going to say, oh, well, maybe I'll just give it a little bit more room and a little bit more room. And then they get stuck. They're like a deer in the headlights and they just can't come out. So you can use dollar cost averaging, or Nightingale, where you say, right, okay, I'm going to go in here and I'm going to add at this level, and then I'll have a secondary add in at this level, and here's my hard stop down here. That's fine, because you're doing that within the parameters of a trading technique. But a lot of people around the world don't use stops. They don't have an overall risk strategy with these things, and then the risk is that if you go and get a 5 standard deviation event or whatever it is, that brings a huge move outside of what you're used to, and that could be, bearing in mind this is a move that we've now seen on the equity markets. It's beating the records, isn't it, really, in how swift we've gone down to what, minus 30% in some markets, and how quickly that's happened. well, your model's just gone out of the water and you've relied on your experience. You might have been trading 10 years and you've been getting away with it for 10 years and then you blow up. So um, it always comes back down to using stop losses, using risk management, and it's the best thing you can do in this sort of environment. So even for people who use stop losses, do make sure. And the other thing is, use wider stops to allow for the volatility. I mean, I'm not talking about just the S&P here, of course. I've not been massively been trading the S&P at all, but I'm using wider stops and still getting stopped out on certain trades. So you have to use wider stops, and then therefore just position size with that. So do a smaller position size but a wider stop. Just gives yourself a little bit more breathing room on some of your trades as well. So that's my video for today. Nightingale, and don't be one of those statistics whereby the end game comes for you. If you've got any comments on anything I've discussed here today, by all means do. We always appreciate a thumbs up as well, and I'll be back in touch next week.